Welcome to The Explainer. Today, we're unpacking a really fascinating and honestly kind of dramatic contradiction straight out of Wall Street. We're looking at MongoDB's fourth quarter fiscal 2026 financial report. Now, if you follow the data infrastructure space at all, you already know MongoDB is an absolute powerhouse. They just released an earnings report that, by almost every historical measure, was a complete home run. But the immediate market reaction? Violently negative. So we're going to use the data directly from their earnings call, market analysts, and product documentation to figure out exactly what the heck happened here and what it actually means for the future of this database giant. So here is the central mystery we're trying to solve today. The numbers hit the wire, expectations were completely blown out of the water, and yet, in the after hours and following trading sessions, MongoDB's stock absolutely plummeted by 24%. I mean, it's a classic Wall Street paradox, right? How can a company report such incredible historical success and just get hit with such a brutal sell-off? Okay, let's dive into this, starting with the reality of what they actually achieved in that fourth quarter. To really understand the shock of this stock drop, you first have to appreciate the sheer scale of their revenue beat. In Q4, MongoDB reported total revenue of $695.1 million. That's a massive 27% increase year over year, and it comfortably beat Wall Street's expectation of $670 million. They also wrapped up the full fiscal year of 2026 with $2.46 billion in total revenue. Honestly, by every traditional metric, top-line growth is extremely robust here. It proves that demand for their unified database platform is really healthy across the board. Breaking those numbers down a bit further, the positive signals just keep flashing green. Their non-GAAP earnings per share came in at $1.65, literally destroying the forecasted $1.48. They generated $159 million in non-GAAP operating income. That represents a highly efficient 23% operating margin. In fact, CEO CJ Desai pointed out this is a rule of 40 performance. If you're not familiar, that's an industry benchmark, meaning their combined growth rate and profit margin comfortably exceeds 40%. And get this, they aren't just squeezing their existing clients. They added 2,700 brand new customers in the quarter alone. That brings their total base to over 65,200. Plus, they saw a record $114 million in net new revenue just for their cloud product, Atlas. So the crucial point is this number right here, 121%. That is MongoDB's net revenue retention rate for the quarter. And actually, that's expanding from 120% last quarter and 119% a year ago. Look, in the world of subscription software, this metric is literally everything. It means that even before adding a single new customer, MongoDB's existing customers spent 21% more this year than they did last year. It tells us that once a company integrates MongoDB into their architecture, they don't just stay, they heavily expand their usage. It proves the platform is incredibly sticky and delivering immense value. And the engine driving the whole shebang is MongoDB Atlas, which is their fully managed multi-cloud database service. As you can see, Atlas now makes up a staggering 72% of their total revenue. It grew 29% year over year in Q4. And importantly, it crossed a massive milestone. Atlas has now surpassed a $2 billion annualized revenue run rate. Whether a customer is building on AWS, Azure, or Google Cloud, Atlas is really becoming the default data layer for modern app development. Oh, and even the non-Atlas side of the business grew 20%, which actually marks its best growth quarter in 2 years. All right, so everything we've looked at so far is incredibly bullish. But here is where the narrative takes a really jarring pivot from past success to future expectations. Now, what's really interesting about this slide is the stark juxtaposition. MongoDB just delivered a highly profitable 23% operating margin in Q4, right? But when management laid out their guidance for the upcoming fiscal year 2027, they projected a very moderate 80 basis point margin expansion for the entire year. To put that in perspective, that's 280 basis points lower than the margin expansion they just achieved in fiscal 2026. Suddenly, the story shifts from explosive growth to a noticeable deceleration. And this brings us to exactly why the stock dropped so dramatically. It all boils down to forward guidance and some internal turbulence. For fiscal 2027, management projected total revenue between $2.86 billion and $2.90 billion. Now, while that's still growing, it represents a growth rate nearly 600 basis points slower than what they just achieved in 2026. On top of that slowing growth and softer margin expansion, they announced an unexpected leadership change. Their chief revenue officer, Paul, is stepping down. So when you combine slowing forward projections with a restructuring at the very top of their go-to-market leadership, well, it spooked Wall Street. It spooked him bad, leading to that massive 24% after-hour sell-off.
Section 1. The AI and Enterprise Moat.
So the market obviously reacted to the short-term guidance, but we have to ask, does this sell-off fundamentally reflect a broken company, or is their core product still deeply entrenched? Let's move to and see how this builds, comparing MongoDB Atlas directly with Amazon's own DocumentDB. The reality is pretty stark. Atlas offers native time series support, complex sharding methodologies, which, if you don't know, essentially allows you to split massive databases across multiple machines, online archiving, and crucially, freedom from vendor lock-in. You can run Atlas on AWS, Azure, or Google Cloud. DocumentDB lacks these advanced features and locks you entirely into the AWS ecosystem. So the product quality of Atlas remains elite, and enterprises know they just can't get that fully featured experience from a generic cloud provider imitation. And this brilliantly illustrates why product quality matters so much right now. CEO CJ Desai highlighted a perfect example of this with 11 Labs. They're a major AI native company, recently valued at $11 billion, and they actively selected Atlas to serve as the long-term memory for their conversational AI agents. Look, in the middle of this AI boom, applications don't just need raw computing power. They require memory, state, and really high-quality data retrieval. Atlas provides this seamlessly through integrated search and vector capabilities, which proves that the most cutting-edge developers in the world are still actively standardizing on MongoDB. Those AI tailwinds are just accelerating across their entire customer base. Now, management did note that AI isn't a massive revenue driver just yet, but the underlying usage metrics, they're exploding. The number of customers using vector search, which is absolutely essential for AI applications to understand relationships between data, has nearly doubled year over year. Usage of the Voyage embedding model has doubled since its acquisition last year. And we're seeing companies like Emergent Labs, an AI coding platform, actively choose Atlas over traditional relational databases like Postgres. Simply put, customers are actively preparing for the AI boom, and they're doing it right on MongoDB's platform.
Section 2, Wall Street price targets. So we're left with a clear contradiction, right? We have soft short-term revenue guidance paired with an incredibly strong underlying product and massive AI usage tailwinds. So how is Wall Street actually modeling this out? Well, the projections are incredibly wide, which really reflects the uncertainty of the moment. Algorithmic modeling from Tixen shows a potential bear case bottoming out around $238.59, while their bull case algorithmic high rockets all the way up to $839.17. That's a huge spread. Meanwhile, Morningstar analysts maintain their fair value estimate right at $303.00. Crucially, though, Morningstar noted that following this massive post-earnings sell-off, MongoDB shares actually appear undervalued. They stated they remain very optimistic about the company's AI-led growth opportunities over the next 5 years.
Which brings us to the ultimate question as we wrap up this explainer. You've seen the massive revenue beats and those incredible net retention rates. You've also seen the slowing forward guidance and the executive shakeup at the top. But you've also seen how deeply entrenched their technology is for this next wave of AI development. So what do you think? Is this post-earnings plunge a value trap that reflects fundamentally slow in growth? Or is this temporary turbulence creating a generational buying opportunity for a foundational tech platform? The data's on the table, and the market's going to decide the rest. Thanks so much for joining us for this deep dive.